Hi everybody, welcome to our quarterly update from the alternatives business. I'm Sumaira Abdi and with me I have Gaurav Mehta. He's the equity CIO of the alternatives piece. So Gaurav, we meet again and in very, very turbulent times. I mean,
Absolutely.
every year we think is volatile, but this year more so. We've seen, the trade wars, and now, of course, there was this looming India-Pakistan war for a bit. But it's very difficult to predict what a leader like Trump might do. We don't know how India-Pakistan is going to shape up. But since you are the head of the asset allocation committee here at SBI Mutual Fund, how are you looking at playing this whole piece? What is the asset allocation like?
So Sumaira, our belief always has been that it's always very difficult to predict short-term market moves, and which is why we fall back on an objective asset allocation framework. And this is a top-down framework that looks at valuations, earnings, and market sentiment. And I think when you look at any priced level of any security, it's a function of valuations and earnings. But I think what we also must realize is that things don't stay at fair value because there is so much of emotional investor emotions that are at work at all points in time. So in periods of exuberance, things overshoot. In periods of pessimism, things undershoot. So which is why apart from valuations and earnings, we also look at market sentiment and we quantify it to get some sense of market direction going forward. I think what's changed over the last 6 7 months, thanks to this correction, is that our readings on valuation as well as market sentiment have eased off a bit. So last year till about September, our valuation readings were very expensive, and we look at equity earnings versus 10-year bond yields. I think what's changed over the last 6 7 months is that there's been some market correction, there's been some earnings roll forward, so that's led to some PE contraction on equities. And equally importantly, and I think even more importantly, 10-year bond yields have moved down by about 60 odd basis points. I think they were 690, 95 earlier. They are now 630, 635. And this combination of a bit of PE contraction and a significant reduction in 10-year bond yields have now moved equity valuations back to historical averages. And when I say equity valuations, I'm largely talking about Nifty and Sensex as the frontline indexes. But those valuations from being very expensive are now back to historical averages. Alongside, I think the second thing that's changed is that our sentiment measure was extremely exuberant again sometime around September of last year. And that from a contrarian point of view suggests lower equity exposures. But I think again what's happened over the last 6 7 months is that because of this correction, sentiment readings have turned back to neutral, which means that now there isn't too much of greed in the markets and hence a lot of excesses have been eased out. I think both these are welcome changes, valuations turning average, sentiment turning neutral, and that suggests that now is back, that time when you go back to your long-term asset allocation. For a good part of last year, our asset allocation frameworks were suggesting underweight on equities. We are now back to neutral levels. Valuations are not outright cheap. Sentiment is not outright pessimistic to warrant a big overweight on equities, but at least you're back to neutral from being underweight. So not a time to be underweight either.
Okay, fair enough. Let's talk about the ESG PMS because we've always positioned that as something which is relatively safe or relatively less volatile, in fluctuating market scenarios, and it has shown resilience, right, of late. Do you think now is the time for investors to actually allocate more and sort of double down on their positions?
So right, Sumaira, I think at the core of it, ESG is imbibing sustainability into investing, right? Because companies that are thinking of environmental, social, and governance factors are also thinking of the long term in mind. And when you think of the portfolio characteristics of the ESG portfolio, this is a portfolio which is focused on long term growth and quality. And I think what's happened over the last 4 or 5 years is that there was a significant move towards value stocks away from quality stocks. And that meant that on a relative basis, quality had become quite attractive on valuations. And also, when you look at the macro environment today, where there is so much of uncertainty, at the same time, interest rates are coming down. I think that is a very conducive environment for quality stocks and for long term growth to get rewarded again. I think even in the correction, that fact stood out. And I think on the other side of this correction, as markets sort of start to recover a bit, you will continue to see markets focus a lot more on long-term growth and quality. So I think from that point of view, ESG is very well positioned, and I think investors should continue to be rewarded if they stay invested in this product.
Gaurav, thank you very much for explaining all your alternative
My pleasure.
strategies. And I hope you found that useful. Thanks very much for watching. We'll see you again next quarter.